Hey guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. What a phenomenal week it has been for the benchmark indices. The Sensex has once again crossed the 50,000 mark and is looking good to go even higher. In fact, since March 2020, I think the Sensex is up some 57-58%, and the BSE small cap index is up 87-88%. Who would have thought back then that Sensex and the BSE small cap index would have such a fantastic bull run? Now, what if I tell you that by spending merely couple of hours back on March 31st, 2020, you would have been able to create a market beating portfolio which would have outperformed both the Sensex and the BSE small cap index over the next 10 months or so, so between March and January 2020. Now, let me just briefly take you through the process on how you would have done this. So, you would have figured out what the fixed deposit rate or the interest rate on a bond was back then, and I think it was around 6.5%. If you would have inverted that, you would have got a PE of 16-17 times. Now, what you would have done is you would have divided the universe of companies between two different groups. Primary group made of primary companies and a group made of secondary companies. Primary companies are companies which are amongst the top 150 200 names in the country in terms of their revenues, and these are the companies with a balance sheet where at least half of the assets are funded by equity. Uh, what I mean by that is when you take the ratio of net worth upon total assets, it should be zero point 0.5 times or more. So, had you taken the top 200 companies in terms of revenues and put them in an descending order based on the net worth to total assets, where the companies with the best net worth to total asset is number one, second best is number two, and so on. And had you taken the top 20 names with the price to earn is multiple that's within a narrow band of the fixed deposit price to earnings or the fixed deposit rate. The fixed deposit rate, as I said, is 6-7%, and which gives the price to earnings multiple of 16 times. So if you would have taken a company's price to earnings range of between 12 and 24 times net worth to total assets in descending order, top 200 companies, that portfolio would have given you almost 87-88% returns. The list is on your screen right now. So as you can see, the list of those 20 companies would have given you 78% returns just by spending a couple of hours. I think this with the kind of databases that we have in the country right now, it would have taken you a couple of hours to put together this portfolio, and if you would have done this, you would have earned returns which are more than the Sensex. Sensex has of course given returns around 57-58%. Now, what about the secondary companies? Companies which are outside the top 200 companies, companies which are small caps and micro caps. How, using the same principle, how would you have zeroed in on a stock or 20 stock portfolio? Uh, Everything else remains the same. The only change that you need to make is in terms of the price to earn is multiple. Since these are secondary companies, smaller companies, slightly higher risk companies than primary companies, you demand a bigger margin of safety. You demand a margin of safety of at least 100% as compared to the primary companies. So if 12 to 24 was your band of primary companies based on the fixed deposit rate, the band for secondary companies is 4 to 8 times, because you want a bigger margin of safety. So if you would have kept your band, price to earnings band of companies between 4 to 8 times net worth to total assets, descending order, and you would have put together a portfolio of 20 companies. This is what the portfolio would have looked like. You would have had stock like Quick Hill Technologies, Wimpla, Sasken, Phenolics, Garware Polyester. and this portfolio would have doubled your money. It would have given you 100% returns. And as you can see, the portfolio of these secondary businesses would have outperformed the BSE small cap index, which has given 87% returns. Now, before you dismiss this as coincidence or luck, let me tell you that there's sound logic behind this. Uh, you're buying strong companies. You're buying companies with a big margin of safety, and therefore, uh, every time you do this, you do this year in year out. Where start of the year you choose companies based on these principles. At the end of the year, sell all the companies, then put the money in a similar portfolio. I can almost guarantee that this portfolio will do well from a long-term perspective. You will not get a bad result using this approach. Whether you get a good result will depend on the stocks that you further filter from this list, the stock that you zero in from this list, and how much of the personal of your own personal expertise and your personal skill set you're able to use. And if you do a great job of stock picking and allocating the money well, then you can get even better results than this. But even by using such a simple quantitative measure, you're able to get good results. Let me also tell you that I have been using this strategy with some tweaks here and there since 2014, and it has done really well vis-a-vis the benchmark index, the Sensex. Sensex has given a return of 13-14%, whereas this strategy has given a return of 19-20%. Now, this 19-20%, the gap is significant. Plus, you also need to consider that 19-20% returns this strategy has given has come after accounting for cash in the portfolio, and the cash has been almost 50% almost all the time. So, a portfolio with 50% cash, and based on criteria, the criteria that I just highlighted, has gone on to give significantly better returns than the benchmark indexes. I mean, investing cannot be more simpler than this, right? So, I always prefer these kind of simple approaches to investing as opposed to the approaches where say a sector-based approach to investing, where you try to zero in on sector with the best growth prospects and then try to identify companies that are, best placed to take advantage of the sectoral growth. Uh, there's a twofold risk when you take a sector-based approach to investing. The number one risk is, even if the sector is a high growth sector, it does not mean that the companies in the sector will be profitable. Airlines is a classic case. One of the biggest growth that has happened in India in the past few years is number of people traveling by air, but still, airline companies have suffered and there have been wealth destroyers on the benchmark index in the stock market. Another problem is, when the sector explodes, takes off, a lot of companies jump into the sector, and to zero in on 2 3 companies which will survive and which will keep on adding wealth is very difficult. It's not that easy. Who would have thought that companies like Infosys, Wipro and TCS would be the wealth creators they are today? 20 30 years ago, a lot of companies were vying to be the largest software companies in the country, and it would have been very difficult to zero in on, say, or Infosys or Wipro and TCS and say that these are the companies that will go on to do well. If you think you are able to do this, all the best to you. For me, I think simple is better. I'd rather stick with this approach than take the other approach of finding the next Infosys, next Wipro, or trying to find the sector with the next best growth prospects. So that was all from my side today. Let me know what do you think of this approach. As usual, I'll be looking forward to your comments and likes and dislikes. And if you haven't subscribed to the channel already, I request you to go ahead and do so. I'll see you around next time. Thank you so much.